Good morning, everyone. Welcome to the Fund Finance Expert Talk. I'm Mbayi, Head of Banking and Finance at the Luxembourg law firm Praxio. Today, I have the pleasure to welcome Richard Braham from CBA. Hi, Richard.
Hi, Michael. How are you?
And you, what about you?
Yeah, all good, thank you.
Yeah, to kick off, maybe you can further introduce yourself, your bank, and your role.
Yeah, sure. So, as you mentioned, I'm Richard Braham, and I work for Commonwealth Bank of Australia. I've been here for 9 years. And just to give a little bit of background, CBA is Australia's largest company, actually, and Australia's largest bank. I think there's about 53,000 staff. I work in the London office. It sort of fluctuates between 195 and 200 people in London. Um, and my role here is I run our European, what we call non-bank financial institutions business, and that covers fund finance and insurers. We've got a team of people in London and a team of people in Amsterdam.
Thank you, Rich. And can you maybe walk us through your career journey in fund finance?
Yeah, sure. So my journey's been slightly different to some extent. So I actually joined CBA as a sort of director of insurance coverage banking. And so I'd spent 11 years prior working at Barclays, where I helped run the European insurance coverage alongside a team lead. And I joined CBA with the remit for growing the international insurance coverage business. And over the course of sort of 2016 through 2020, sort of brought on many different global insurers, reinsurers, and sort of worked out through that period that there was a convergence of ecosystem, if you like, between how insurers were then also thinking about funds, sponsors, and how institutional cash. And actually, in 2019, a prominent market player left CBA to change their career, but also moved to another fund finance role. And the opportunity for me was to interview and take on the funds role within our institution as well and grow that business. So then I was responsible for our insurance division and also our funds finance coverage business. So my journey in fund finance is probably well, since 2019, it began in earnest. When before that, I sort of saw it growing through previous roles at Barclays and then seeing my colleagues work on these client set in CBA.
Mhm. And Rich, with your particular background in insurance, what kind of advice would you give to a seasoned professional wanting to enter into the fund finance business and having a fund finance career?
I think more generally, what I've learned is that it's an exceptionally collaborative sector, the funds market more generally. So when I joined the sort of sector more broadly in 2019, 2020 in earnest, it was obviously an interesting period to join because my first sort of year and a half, it was more during Teams calls, lockdowns, and getting to know the market through a slightly strange environment. But what I would say is all the market participants were so welcoming and collaborative. It does feel like the sort of environment where you have you learn and grow together, as opposed to other sectors where it's probably more there's definitely more of a threat of not wanting other entrants. Whereas with fund finance, I feel like actually new bank lenders coming in offers an opportunity for other
Mhm.
banks to learn as well, or non-bank lenders provides efficient sort of use of the additional lending capacity to the market, or institutional cash. So I guess to answer your question, it does feel like the sort of market that's open to new entrants from a personal perspective as well as sort of market participant.
Mhm. That's true. This is in the DNA of the fund finance industry. This collaborative element, the fact to be seen not only as an industry but as well as a community. And
Yeah.
in terms of challenge in your career, have you had some challenge that you want to share with us, and or have you faced those challenges?
Yeah, sure. I mean, I can give you a couple of personal experiences, maybe not necessarily from the funds industry, because I can let people work those out for themselves, I guess, as we've gone through journeys. But during my time in Barclays, I had a situation where I was moved. My whole team were moved from a corporate division to an investment banking division, and I guess in a banking career, it's not unusual for restructures to happen. And within that period, I had the team leaders and managing directors that chose to leave. and therefore, and if the way you divide clients was difficult. But for me, I was fairly junior in my career at that point. And what I would say from my perspective is that I got the benefit of actually becoming an investment banker, not by interviewing, which at that point in my career, maybe I would have struggled to get into an investment bank actually, but I took the benefit of actually a couple of years of learning and growth from a situation that was really difficult for those that were more senior than me at the time. So that was challenging, and also the workload was very different as well, because in a more junior role, I actually moved into a securitization team, and it was during 2007, 2008, and 2009, where the GFC was obviously happening, and certain clients where historical securitizations was sole level of funding, that sort of dried up, and you had to work out, well, what does that mean for how you operate in the market? And again, when you're a fairly junior in that environment, you never learn as much as from difficult scenarios. And I would say the learning I took from a risk management perspective and understanding, and to not have sole reliance on one source of funding in an environment such as a financial crisis, sort of gave me a really good standing for how I approach risk management for the rest of my career, actually. So yeah, a couple of obstacles that came my way, certain things that were outside of my control, and then things that sort of became back within my control to learn and to develop, I guess. And also just being open, I didn't particularly enjoy the culture of investment banking. And so for me personally, I took all the learnings that I could, used all my experience, and then I moved back to a corporate banking division thereafter, which brought me back to becoming an insurance relationship manager, but in a more senior capacity, because I took on board the skill set of risk management as well as client coverage.
And over the last 12 months, in terms of market update for the sublines, what have you seen from your side?
Yeah, I think it's been what I would say on sublines. So the majority of the portfolio that I look after within our European team is sublines and the capital call facilities. And what I would say is that it's still a very popular tool within the fund finance industry. So 5 or maybe 3, 4 years ago, I was definitely feeling like if we weren't moving away from capital calls, maybe we weren't following the market. But actually, what's happened in the last 12 months from what I've seen is that as fund lives maybe get extended, as M&A has slowed up, exits have slowed up, valuations and the likes become more difficult, fund lives have been extended. Uncalled capital within the funds have remained fairly steady, which has meant that maybe years ago, capital call facilities would have been finished and they transitioned to other types of lending. That hasn't happened as much, and actually we're getting more requests for capital call facilities further down the life of the fund, which from a risk perspective has some challenge, but also the actual profile as a banker is still very achievable. So we've seen that. And the other thing I'd say I've seen in the last sort of 6 to 12 months as well has been the introduction of tranche B to these facilities, whether they're subordinated and whether they're different sort of funding that's actually bringing into these tranche B facilities, whether it's just banks or whether it's institutional money. We're definitely seeing changes to the way that the documentation is structured to allow for this other source of funding within capital call structures.
And in terms of broader market update, what are you currently seeing?
Yeah, I think I touched on it in the last question, but in terms of institutional cash coming into the sort of fund finance market, we've seen that steadily over a couple of years, but it's definitely becoming more prominent. Interestingly, we're seeing a lot of it come from insurance, from where I sit, insurance money. Now the way in which they can structure how it comes into facilities seems to be different to what a bank can do, because it's just a different product, obviously. And maybe there's more term lending that's coming from that side, and therefore allowing the banks to still have a role with the revolving credit facilities, and also being competitive where we can with term tranches. And then what I'd say, because of this institutional cash, you've seen a higher level of supply of potential sort of opportunities for fund financing, and therefore borrowers are pushing tenors as well. So again, 5, 6 years ago, maybe the norm for what I was seeing was in the 1 to 2 year and at a stretch 3-year brackets. I would still say the majority of what we see is in that sort of 1 to 3 year bracket, but we are seeing a push on tenors where some of the larger sponsors are sort of requesting 4-year tenors, because they want to secure funding for obvious reasons, and also there has been margin compression because of higher supply within the market. So more broadly, there's also additional technology available. So we're seeing securitization of fund finance facilities, and therefore you're seeing other ways and an evolution, if you like, alongside the mainstay products. So I would say you still have the main products of the capital call facilities, and they're staying for longer in the life of the fund. We're still seeing specific banks that do NAV facilities, and we are looking at NAV as well for specific asset classes. But we're also seeing institutional cash that's bringing other alternative methods of fund financing to our clients.
Thank you, Rich, and thank you for your time today and your insights. It was a pleasure having you with us. Thank you as well to the audience for your time, and see you soon for our next Fund Expert Talk. Bye-bye. Cheers.
Thanks, Michael. Bye.
Cheers.